Habibi Najihah Binti Norza Azham. I would like to explain what is interest rate and fact that we explain well by using expected theory and liquidity premium theory. Interest rate can be defined as the cost of borrowing or gain on lending, whereas in interest rate we encourage people to save more and tend to moderate economic growth, also reducing inflationary pressure. Expected theory is implied so the investor can predict future changes in interest rate by simply observing the yield spread. Liquidity premium theory is when interest rate that offered is high, so the investor will give up on liquidity in exchange for high interest rate for waiting better rate of return. Fact number 1 is interest rate on different maturity bonds move together over time. Fact number 2 is yield curve tend to have upward slope when short-term interest rate is low and inverted when it's high. Fact number 3 is yield curve typically slope upward when liquidity premium high with a bond maturity. Expected theory is the best theory for explaining fact number 1 and fact number 2, while liquidity premium theory can explain all the theory because liquidity premium theory is the combination of expected theory and the segmented market theory. For further explanation, that will be explained by my teammate.
Hi and Assalamualaikum. My name is Atiqah Binti A.Wahab and I will explain about the expectation theory. Expectation theory is invented to help the investor to make a decision on buy or sell security by referring to a forecast of future interest rate in order for them to maximize their profits. They have a few assumptions in this theory which the term structures of interest rate of long-term and short-term securities are perfect substitutes, where interest rate on long-term bonds will equal with an average of short-term interest rate that people can forecast the interest rate to occur over the life of the long-term bond. To simplify the expectation theory is it can predict that short-term interest rate will determine the interest rate on long-term securities. For instance, investor buys a 1-year bond that pays 9% of interest rate. They expect the interest rate in 1-year bond or short term to be 11% for the next year. Then the expected return for buying 2 short-term bonds average are 10%, which is 9% plus 11% divided by 2. Thus, the interest rate on the long-term bonds or 2-year bonds must be equal to 10% for investors to be willing to purchase it. Therefore, we can conclude that the short-term interest rates are a portrayal of long-term securities. Moreover, investors or buyer of bond do not prefer short-term period over another, so they will not hold any quantity of a bond if its expected return is less than another bond with a different maturity. Despite of that, their yields differ only because short-term interest rates are expected to rise or fall, and the second assumption in this theory are they do not incur any transaction costs in shifting between short-term and long-term securities. That's all from me.
Assalamualaikum and hi, my name is Nurul Izzah Binti Azhar. I would like to explain about liquidity premium theory. Liquidity premium can be defined as any form of additional compensation to encourage investment in assets that cannot be easily transmitted into a cash. Investor would prefer highly liquid that can easily sold in the market without lowering price. The changes in interest rate will compensate investor for higher price risk. The most liquid asset is cash. It is the ultimate liquid asset. The easier it is an asset to convert into a cash, the more liquid it is. As you know, liquidity is important as it allows you to pay for basic livings and expenses and also for future emergency. In this theory, it explains that investors in illiquid assets require compensation for added risk of investing their money in assets that may not be able to sold for extended period, especially if the value will fluctuate with the market. I will provide examples. Assume an investor is planning to buy a corporate bond. There have 2 choices that he will choose, which have the same maturity and also the coupon payment. One of the bond is traded for public exchange, while another one is not traded in any exchange. Investor is not willing to pay for non-public bond. Higher premium at maturity, different prices, is the liquidity premium. That is all from me. Thank you.
Assalamualaikum, my name is Shahirah and I will explain about the relationship of the yield curve of expectation theory and liquidity premium theory. So based on the graph, it shows that the investor expected the short-term interest rate to remain constant in the years to maturity. So this is why the yield curve of expectation theory is flat. It is related to the first fact that the interest rate of different maturities are moved together over time, while the yield curve of liquidity premium theory is upward sloping because usually liquidity premium is positive and grows as the term of maturity increases. It is related to the second and third fact that when the short term of interest rate in the first year is low, the yield curve will upward slope and vice versa. The third fact is the yield curve almost always slope upward because usually the short term interest rate is lower than long term interest rate. This yield curve can predict the economy's activity as it can be forecasting interest rate by comparing the short-term and long-term bonds. The slope of the yield curve provides a clue to the direction of the future short-term interest rate, which an upward sloping curve indicates that the financial market expects a higher interest rate. The downward sloping curve indicates expectation of lower rates in the future, so the buyer of the bond will choose to purchase the bond with higher expected return as the price of bond will decrease. Then, this yield curve can determine borrowing and lending maturities in the short term or long term. Moreover, the yield curve can help in selecting individual securities. They can buy in treasury bonds, corporate bonds, or others with higher expected return. Usually, short-term interest rate must be lower than long-term interest rate. But during recession, the yield curve will downward slope or known as inverted yield curve in which the short-term bond has higher interest rate than long-term bond. So it will increase demand for the short-term credit as they will get higher return to the short-term period. The yield curve is often seen as the way to predict the turning point of the business cycle.
Assalamualaikum, my name is Nadhirah Hannan. The advantages of expectation theory. Firstly, it gives a fair understanding of the interest rate to the investor. Secondly, the theory assumes that long-term rates can be predicted by using a short-term rates. So this excludes the scope of arbitrage. Next is advantages of liquidity premium theory. First is additional risk premium helps companies attract patent capital or making a sustainable investment. Secondly, investment of patent capital helps companies save a significant cost of frequent rounds of raising financing through primary and also secondary market. The disadvantages of expectation theory. First, there is an assumption in this theory. As an investor, they should know that the theory is not completely reliable and can give them a wrong calculation. Besides, the number and the formula are theory-based and using it sometimes may give over or underestimation of future rates. Thirdly, this theory ignores the external factor which affect the short-term interest rates, making it more complicated to forecast. Next, for the disadvantages of liquidity premium theory. First, liquidity risk premium assumes an upward sloping yield curve, which may not be true in case when economic recession occurs. Secondly, any kind of potential permanent change in the credit quality of an issuer expose investment to the risk of downgrading rating, which shall suffer returns significantly.
For the conclusion, the slope of the yield curve reflects the direction of future short-term interest rate. An upward sloping curve suggests that financial markets expect higher interest rate in the future. The yield curve that had been used in explaining the theory is for decision making, which is for forecasting interest rate, determining borrowing or lending maturities, selecting individual securities, and for pricing new issues. Expected theory help investors who would like to invest in any type of bond with a clear understanding of the interest rate, while liquidity premium theory help long-term capital investment to allow companies to avoid the high expenses of raising cash on the primary and secondary markets. But that theory can be inaccurate, so the investor cannot only depend on that theory calculation.